Dr. David Msbn, Executive Director of the Mona School of Business and Management. Mr. James Moss Solomon, Executive in Residence at the Mona School of Business and Management. Dr. Marlene Street Forrest, the General Manager of the Jamaica Stock Exchange. Miss Allison Peart, the Acting Managing Director of Peart Advisor Services in Jamaica, and Mr. St. Elmo White, the lecturer in the Department of Mathematics at UWI, all other guests and friends and family of the Mona School of Business and Management. Welcome and good evening. Welcome to another exciting session in MSBM's suite of online public fora. This evening's theme is equity for local investors in Jamaica. Pun intended, as we will be discussing the evolution of the taxation policy on returns on equity investments in Jamaica. We have three exceptional presenters this evening who are very experienced in their various fields, and so we look forward to a very dynamic and vibrant discussion during our Q&A session. I take this opportunity to remind us all to keep our microphones muted, place our questions and comments in the chat, and use the raise hand feature during the Q&A segment. Without further delay, allow me to welcome Dr. David Msbn, Executive Director of MSBM, to deliver his opening remarks. Welcome, Dr. Msbn.
Thank you very much, Anisha, and welcome all, and in particular to our presenters, Marlene Street Forrest, head of the Jamaica Stock Exchange, Elmo White, who, apart from being a lecturer, is also one of our foremost attorneys, and also Allison Peart, who is also a board member of the MSBM and is a tax expert, among other things. Today's topic is very relevant, as the equities market has been a source of great value and growth for many Jamaicans, rich and poor. And the question of how we tax returns on equity is always a hot button topic. And I'm sure many of us here will want to know how it affects us. Even if you don't invest directly in equities, it is most likely you have some sort of pension fund or other grouped investments. So one way or another, it's going to affect how we generate wealth and prepare for our future investments and returns and retirement. So I'd just like to say thank you to Jimmy Moss Solomon for once again driving this. This is one of the series of engagements that we have with the public at large. And as a business school, we're always very conscious of delivering value to our stakeholders in many different ways. So not just through our formal education or our short courses or consultancies, but also through seminars or webinars such as this, which discuss topical matters pertinent to the business landscape. So once again, welcome. I know that we have both internal and external audiences. To our external audiences, we welcome you to this forum, and we value your feedback, and I encourage you to participate and let us know even suggestions or other topics we should be taking on. So thanks again, and back to you, Venetia.
Thank you, Dr. Msbn. Our first speaker this evening is Dr. Marlene Street Forrest, who is the Managing Director of the Jamaica Stock Exchange and Director of both its subsidiaries. Her mandate is to continue the process of developing the JC Group, and particularly the exchange. in an atmosphere of transparency and fairness, while utilizing appropriate technology in providing the greatest possible efficiencies in the market. Dr. Street Forest has a wealth of experience, having worked in senior management positions at varying private and public sector organizations here in Jamaica and overseas. It is under her stewardship that the JSC became demutualized and the US denominated market and the junior market were launched. She also spearheaded the registrar division of the Jamaica Central Depository when she served as general manager for this subsidiary of the JSC. In 2016, Dr. Street Forest was conferred with the honor of the Order of Distinction in the rank of Commander in recognition of her outstanding leadership in the growth of the Jamaica Stock Exchange. Dr. Street Forest was conferred with an honorary doctoral degree in public policy by the University of the Commonwealth Caribbean on July 18, 2021, for her contribution to nation building. Ladies and gentlemen, please welcome Dr. Marlene Street Forest.
Good evening, everyone. Moderator, Mrs. Benister Barnes, Dr. David Msbn, Executive Director, MSBM, Mr. James Solomon, Executive in Residence, and fellow panelists, Miss Allison Peart and Mr. Winston St. Elmo White. Good evening, ladies and gentlemen. First, let me thank MSBM for inviting me this evening to participate in this very important panel discussion, Equity for Local Investors in Jamaica. And as Mrs. Barnes said, it's really a pun on the word, because as I saw it, I said, well, look, we are talking about equity for equity. You know, it is the equity in investment comes first, and it's the precursor for the equity that we must see in terms of how we treat with the issue of what persons get as a result of investing in the market, which are dividends and also capital gains. The discussion there's always been at the stock exchange by brokers, by financial sector players. Always we have had a discussion on this with the government as to taxation. And generally now I'm talking about the benefits of taxation, the injuries of taxation. And as an exchange, we have benefited from the benefits of taxation. And we, in particular, we have been certainly over the years speaking about this particular area of dividend taxation. While we discuss this matter, I want to put on the table that it is fair to say that taxation is a must for government. We appreciate that. We have seen that not only in Jamaica, but the world over, there is a concern about taxation. And even just recently, global governments have come together to look at issues such as tax haven and how do you treat with taxation. So we understand that taxation matters. But this evening, I just want to lay, because I'm the first person speaking, a discussion on the brief background of taxation, the equities market development, the history of the dividend tax I'm talking about, and market opportunities and the lobbying effects. And why would we should still lobby for look at taxation as it is? Let me now share my screen with you. Okay, so so those are the discussion points that I just spoke about. Now let us look at persons who invest in the market and receive a dividend, And it's not only about the public market, but also the private market, the private companies do receive dividends. But if one were to concentrate on the public market, there are two areas that you can receive benefits having invested. It's in terms of companies providing a dividend, looking at their profits and seeing how much of that will I pay out to my shareholders, my investors. And this is 15% at this point. Withholding tax is applicable for resident shareholders, where bodies corporate or not, with some differences in substantial holdings. And I won't go into that. I imagine my fellow panelist, Allison, will go into that. Then there is the capital gains tax. And this no tax is applicable for capital gain. But again, understand that you do not reap that benefit unless you sell those shares. So that benefit is not realized until that happens. The fact is that when we look at government, we have to look at why it is that and what are the guiding principles that pushes them in terms of the various steps they take and the various tax measures that they take. And we can see that really it's to fund recurrent expenditure for growth. It's also effective in terms of looking at inequalities. And I want you to underscore in reducing inequalities while I speak. Then there is the ensuring that there is the taxation, it attracts development, and also that whatever taxation is put, it's not detrimental to citizens' well-being. And obviously, it must have a balance between a simple way of persons understanding and collecting revenue to facilitate growth. So the discussion this afternoon about dividend will be in line with, is it equitable? Is it detrimental to citizens' growth? What can we do if so? And what are the government's considerations? What has been done, we have had prior to 2008, 2000, there has been quite a bit of lobbying with the government as to what are the reasons why one should consider the elimination of tax on dividend. One of the major reasons, and I have no doubt that this is why changes were made, it represented a double taxation as profit has already been paid at the company level. So the fact is that when you withhold a gain based on a distribution of dividend or a payment of dividend, it is payment taxation twice. It is considered that. The prior to 2000, somewhere in 2000, the dividend taxation was really on companies that were listed companies. And the reason for that also is that the development of the capital market is critical to growth. And the formalization of companies is also critical. We're talking about the idea of corporate governance. And so the consideration was in respect to listed companies to encourage formality, to encourage to improve taxation. So we're aware that those issues were looked at in respect to consideration by the governments as to what should we do in terms of, again, looking at equity, fairness for all, and growth of a capital market. And so prior to 2000, 25%, this is a chart, this dividend history, 25% of the dividend for individuals and 33% for companies. That's what prevailed. April 2000, it was reduced to 20%. April 2001, reduced to 10%, and in 2002 eliminated. In 2009, there was now an elimination. So the concentration was not now only on companies that are listed on the exchange, but in 2009, January, there was an elimination of taxes to also non-listed companies. And then we see that within the year 2009 again, a decision was taken that it was necessary to do a tax on non-resident corporations. They would be subject to 33 1/3%, and non-resident to 25%, and a non-resident corporation subject to 33. Let me repeat that, and non-resident individual to 25%. Now, in June 2012, there was an introduction of 5% as a final tax, and April 2013 to current 15% on dividend. That's the tax as we speak. Now, the question is that one should ask, how does that 15% affect individuals? Let me just indicate here that since 2000, we have seen a significant growth in the number of persons participating in the stock market. And so, whereas even at 2000, where one would not have, one could say this particular consideration does not affect a whole lot of persons, because in 2000 we had some only 23,829 account holders in the JCFE, which sort of give you a sort of the universe. And 2001 we grew to 30, but 2004 to 2012 we are looking at 108,317. And Dr. Msbn in his opening did indicate that this is an area that affects quite a number of persons. And 2013 to October 2021, we have 233,199 account holders. And even if you reduce that based on probably there are few that have more than one account, and you multiply that in terms of the households that it affects, you can see that this is an area that affects quite a large percentage of Jamaicans. So it is really time for us to look back at this and to say, yes, we understand still that taxation in any country is important, but does it not, when you look at it, the reasons that were given when the decision was taken to make it nil, are those reasons not still relevant today? If the answer is yes, then we need to look back at this, and we need to look back at it with some urgency. And does it raise a question again of equity? And we have said it is a form of double taxation, so it does raise the question of equity. And I am going to put forward, because we are current and we must think current, that COVID-19, we want, there has to be an avenue of stimulating, and I want to make the connection between the taxation on dividend and the number of persons that we have now in our account as account holders, and the fact that we have more companies that are paying dividend, that one should make that connect to see how a consideration and a relook at dividend taxation can benefit and can stimulate the economy. I want to pause here. I think that persons to just understand that as a stock exchange, this is something that we have been pushing. We continue. You notice I said at the opening lobbying, and we continue to lobby on the actual removal again of taxes on dividends. Thank you. These are some serious considerations that we really have to grapple with. Thank you.
Thank you so much, Dr. Marlene Street Forest, for that very informative and thought-provoking presentation. Lots of things to think about and lots of questions, I'm sure, lurking in all our minds as we're listening on. And not to delay us any further, let me continue on to our second speaker this evening, who is Ms. Allison Peart, the Managing Director of Peart Advisory Services in Jamaica. She has over 28 years of public accounting experience with the major 4 accounting firms, the Big 4 in Toronto, New York, and Jamaica. She commenced her accounting career in downtown Toronto in KPMG's audit practice, specializing in financial institutions. She was then recruited by Ernst & Young's international tax practice, where she worked in Toronto and New York before being asked to assist with establishing a practice in Jamaica. Ms. Peart is a Canadian chartered professional accountant and chartered accountant with extensive audit, management, and advisory experience, and has spent time setting up tax structures in various countries, including Canada, the US, Hungary, and Luxembourg. A graduate of the University of Toronto, she has worked with several clients in Jamaica, the Caribbean, Latin America, Asia, the US, and Europe across a wide range of industries, including retail, distribution, manufacturing, banking, insurance, and hospitality. A member of the board of directors of MSBM, Ms. Peart was instrumental in conceptualizing and assisting the University of the West Indies to develop a work-study co-op program for accounting students to receive paid internships while completing their undergraduate degree in accounting. She has been a member and affiliate of several notable associations, including President of the Institute of Chartered Accountants of Jamaica, Fellow of the Chartered Professional Accountants of Ontario, Canada, Registered Public Accountant with the Public Accountancy Board in Jamaica, immediate past presidents, and member of the Board of American Chamber of Commerce of Jamaica, and Vice President of the International Women's Forum Jamaica chapter. Ladies and gentlemen, please welcome Ms. Allison Peart.
Good afternoon, everybody. You know, when I hear these introductions, I sometimes wonder, boy, I'm getting up there in age, right, Marlene? But we pretend that we continue to be young. You're only as young as you feel. And I want everybody to know that we're alive. We're surviving COVID. So we need to ensure that we look very carefully at our lives and how we invest our money. So not give you digestion at lunch, at dinner, but we're gonna take up from where Marlene started. She gave us a good history of taxation. And it's interesting because I returned to Jamaica in 2002 and had a bit of a heart attack when I saw the tax rates that we had on dividends. So I'm gonna do a little bit more and raise some issues. So we're gonna talk about a little more deeper about dividends, capital gains, the redemption gains from collective investment schemes, because that's also something we should be aware of. The treaty dividend withholding rates. What do you pay to, if you're a company, what is the withholding tax rate that you would have to pay over to the government of Jamaica if you have non-resident shareholders? And the global minimum tax. We're gonna just touch on it because we hear it, and I want to bring a little bit of clarity in terms of how that, what impact on us with our local investors. All right, Marlene spoke about it, but I want to clarify a couple things with it. Ordinary dividends, because we talk about dividends, but there are various kinds of dividends. So ordinary dividends, dividends that you pay out of the profits of a company. The final tax is 15%. So it is a withholding tax, but I want you to realize something. A withholding tax is not always a final tax. In some instances, it's just the withholding and then you have to file and pay. In Jamaica, individuals and corporates, it's a 15% final tax. So they withhold the 15 and you have to pay it. Now, if you are a company and you pay it to a company that owns 25% or more of your voting rights, there is no withholding. So it goes to that company zero. And it's when that company pays out to persons who own less than 25% of the voting rights that 15% gets withheld. Now, why do you think we withhold? It was a change in law some years ago when the IMF first came. Roy Collister did this, where he felt that based on the population of Jamaica, we shouldn't have to file tax returns and that, you should withhold. So this change of withholding means we don't necessarily have to go and file income tax returns if we're only earning PAYE. But there are situations where if you earn income and you're paying a 30% income tax rate, you really are supposed to pay and file income taxes in addition to the withholding. With the dividends though, the 15% is the final tax. It's not 25, it's not 30. So the withholding is 15 and the final tax is 15. Now, ordinary dividends that are covered, we just discussed, but there are also preference dividends. So preference dividends, depending on the characteristics, can be deductible for tax purposes. So they're treated similar to interest. So if it's a preference dividend, if you're an individual, you're going to be subject to the income tax at 25% or at the 30%, depending on how much money you earn. Because remember, we do have a difference in rate depending on your income threshold. In addition, if you're a corporation, then it's 25, it could be 30, it could also be 33 and a third. And one thing I should point out, we talk about a 25% corporate rate, but bear in mind, there's an employment tax credit that if you file your payroll taxes on time and you file your corporate taxes on time, you can, depending on whether you are, if you're not a financial institution or a bauxite company, there are certain exceptions, you can lower your 25% down to 17.5%, depending on the size of your workforce. So we talk about 25%, but bear in mind that depending on whether you claim an employment tax credit, it could actually go down to 17.5%. So I'm just making sure that we're understanding some of the nuances. Also, if you are fortunate to be listed on the junior exchange, you actually, for a certain period, pay zero tax. Capital gains. Marlene talked about it. We currently do not subject capital gains to tax in Jamaica. I can tell you when I returned from Canada, I was very excited about this because Canada does tax capital gains. It taxes a portion of it, but we don't. Thank you, Lord, we don't. However, bear something in mind. There is a 2% tax. It has been lowered. It used to be when I first came back here, it was 7.5 plus a stamp duty of 5. It has now been dropped to 2%. So there is a transfer tax on shares unless you transfer them on the Jamaica Stock Exchange. So bear in mind that there's no capital gains tax, but there's a 2% transfer tax, which applies. The stamp duty is now nominal, but there is a 2% transfer tax that applies unless you're moving your shares through the exchange. So bear that in mind, that there is something good at the stock exchange. If you own those shares there, you don't pay that transfer tax. Investment schemes. A lot of us forget about this one. We talk about unit trusts, etc. The regime was changed and it's now called a collective investment scheme. With the collective investment scheme, note that with a few exceptions, we're talking about long-term accounts. If you have an investment in a collective investment scheme, there is a 25% withholding tax. And that withholding tax applies even if it is invested only in equities or real estate. I am aware that the tax authorities and the Ministry of Finance are looking to see if they can change this, because it would be unfair for you to have no capital gains tax if you bought real estate or equities directly and then have to pay it if you are in a collective investment scheme. So I'm just making you aware that dividends are 15%, but 25% is the withholding tax in the collective investment scheme. Bearing in mind that when you receive the income, you have to look at what your tax rate is, right? Good. This big screen, we're at UE, so we have to learn and put, I'm going to pretend I'm an instructor. Blind your eye, but I'm going to talk it through. These are the country's dividend withholding taxes. Bear something in mind as well. A dividend withholding tax to a non-resident is not necessarily the final tax. It is merely the tax that the Jamaican government takes and removes from the payment of dividends. When the investor receives the income, they now have to look at their country's tax rate or tax rules to determine how that is treated. Some countries give a credit for the taxation that is withheld. Some countries don't give a credit and they give an exemption. So let us look at, if you're a company, and as a local investor, we need to know what it is that our government is withholding from foreign companies and individuals when they come and they invest in our companies. So Canada has a very old treaty. It's 15% withholding or 22.5% if the company that you're paying to owns 10% or more of the shares. Can you imagine? So normally you have portfolio dividends. Those of us that are accountants, we use these portfolio versus substantial owning. If you have a portfolio dividend in Canada, so if a Canadian investor is investing, they actually get a lower withholding than if they own the company 100%. So under the treaty with Canada, it's 22.5% if you own more than 10%, 15% if you own less. China, we forget that we have a treaty with China. We've had a treaty for some time. It's 5%. So the withholding tax, meaning the tax that Jamaica takes off the payment to China from dividends, is 5%. Denmark, it's 10% or 15%. Now, you notice the European countries are a little different, whereby you pay a lower rate if you own 25% or more. So you'd pay 10% if you own 25% or more of the company, 15% if you're a small investor and its portfolio. France, similar to Denmark. Germany, similar, except France drops it to 10%. Germany has it at 25%. Israel is like Canada, where it's 15% if you are owning 10% or more, but it flips what Canada does. Canada has a higher rate if you own more. Israel has a lower rate if you own more. So it's 15% or 22.5%. You hear the rates that are taken off. Japan, 5%. Japan is a brand new treaty. So a lot of people don't even realize that we have a treaty with Japan. Came into force last year during COVID. It's 5% or 10%. Now they have a very interesting treaty because they have a holding condition with 365 days. So with the Japanese treaty, you have to look very carefully at it. Mexico, that's also a fairly recent treaty, 5% or 10%. The lower rate is paid if you own 25% or more. You see, we have more treaties here. I wish we had even more. Norway, 15%. They don't care what you own. 15% is what Jamaica withholds. Spain, 5% withholding or 10%, lower rate if you're 25% or more. Sweden, 10% or 22.5%. 10% if you're 25 or more, 22.5%. So we're seeing the big differences in the rates for non-residents to invest. Switzerland, 10% if you own 10% or more, 15% withholding if the 10% threshold is your higher. United Kingdom and Canada have very similar treaties and they're very old treaties. 15% if you're a portfolio investor owning less than 10%, 22.5% if you own more than 10% of the company. So you can imagine, companies that are 100% owned by UK companies, they're paying a higher rate. The United States, also old treaty, the treaty is from the Reagan era, 10% versus 15. 10% if you own 10% or more, and it's 15% if you're higher. CARICOM, we always hear about this CARICOM because there's always talk about St. Lucia, Barbados, and CARICOM. Like the European Union, when the CARICOM treaty was brought in, it was felt that because we want to have investments around the region, we shouldn't pay dividend withholding tax on it. So the CARICOM treaty is a different treaty. It's a UN model treaty, which is an exemption treaty. So if you're paying to a resident of CARICOM, a tax resident of CARICOM who are resident in the country, I want to make this distinction because some people get confused and think if you just pay to a St. Lucia company or pay to a Barbados company, you get zero. You don't. Bear in mind that Jamaica has mind and management rules to determine where a company is tax resident. So people who set up a Barbados or a St. Lucia or any company in Trinidad, Barbados, any of these jurisdictions that are party to the CARICOM Treaty, if you're in Jamaica and you're not flying to the jurisdiction and having your treaties, you don't have directors there, they have actually brought in new rules with regards to substance. So if that company in the CARICOM territory has no substance, you may actually have a Jamaican company and it's supposed to be 15%. So I'm cautioning people, when you hear about this 0% tax, bear in mind that it's not just because they're set up in Barbados or St. Lucia, their mind and management as well as the increased substance requirements need to be fulfilled in those countries for them to benefit from the 0%. One of the distinctions is with the other treaties, when you have the withholding, they have to go back to their country. So to give you an example, if it's a US company, the US company, if you own more than 10%, you're paying 10% of dividend withholding. When you go back to the US, you look at your tax rate. So your corporate rate, let's say it's 21% that you'd pay the additional tax and get a credit for the 10%. So your maximum would be the 21%. So I want to make that distinction that depending on what your tax rate is in the US, you may not be paying 10 or 15, you may be paying the higher rate. With CARICOM though, if you're paying to a CARICOM jurisdiction, it's a final tax. When the income goes to the country, assuming it's a tax resident in that CARICOM jurisdiction, there is no further tax. It also goes both ways. With these treaties, it's the same thing. If we're Jamaican investors and we invest in the US, the 10 and the 15% withholding would apply to us as well. And we would then have to file our return to pay the extra tax rate. So if you're an individual and you're subject to 25%, US would have taken off the 10 or the 15%. You would then have to file your tax return to give the difference. So if you're at 25% and the US took off 10, you'd have to file your return to pay the 15. If instead you receive dividends from Barbados or Trinidad, 0. So they take off 0 on the dividend. When you get it in Jamaica, you don't pay any further tax. So I want to make that distinction with these withholding taxes. So it goes both ways. So it means we also need to try to invest in a lot of our CARICOM jurisdictions where we can get money because we don't pay the taxes here. So it goes, they don't pay the taxes when they invest in us with the dividend. So there's no withholding and no tax. They don't pay it. But if you're investing in the US, there is a potential for more tax and you need to make sure you file your return. Now, not every country has a treaty. You notice the countries I listed. If those countries that you are working with are paying dividends are not on this list, it's 33 1/3% right off the bat. They don't care what your holdings are. And if you're an individual, it's 25%. So if you're living in a country that has no treaty with Jamaica, that's the rate you're paying. All right, regardless of what your tax rate is in the jurisdiction you are in. And it also means this is where some double taxation may come in, because some countries, if there's no income tax treaty, when you pay to the non-resident and they receive it, they may not give a credit for the 33 1/3% that Jamaica takes off. You may still be subject to their tax. So in terms of getting investments, I just want our local investors to know, when you're looking globally, because we all should, bear in mind, watch what the treaty says, because if you're not careful, you may find yourself paying taxes in a foreign jurisdiction, assuming TAJ is going to give you the tax deduction and there is no treaty or tax credit, and you pay double tax. Bear in mind, there is no law against double taxation. That's a myth. A government can put whatever the tax they want on you, and they double tax us all the time. So I just wanted to bear that in mind. Now, this global minimum tax, the base erosion profit shifting, BEPS, not BOOPS. We're in Jamaica, we like to play around with these names. The BEPS initiative, remember that. Marlene is here. She just about had a heart attack about 7 or 8 years ago when I came to her to her Jamaica Stock Exchange forum and talked about this BEPS initiative that was coming. BEPS has spawned this 15% global minimum tax. It really came out of a digital tax where there was a feeling that global companies in the digital space were not paying their fair share of tax, because normally, and I say normally, taxation is based on physical presence. So you're, as a local investor, we talk about resident companies paying taxation because they have a physical base here. With the digital, we are touching and feeling. I mean, we're right here doing a seminar. We could be anywhere in the world doing this. If this was charging money, whose taxation should collect it. So the whole issue of digital taxation spawned the 15% global minimum tax. It was fought by the US for a while under the Republican administration, but the Democrats have embraced it. It's 15% currently. It could change, but this is the rate that everybody is agreeing with. And just so you know a little bit about this global minimum tax, you're like 15%, what does that mean? There are certain thresholds. It's going to be introduced. There's a transition period, but they're looking to have it come in such that companies, that earn 750 million euro, this will be subject to you. This will be the 15%. No, don't be surprised. We have some of them here. Some of our big companies will have this issue as well. And bear in mind, as local investors, when foreigners invest in our country, they could be watching the minimum business tax that they have to pay, because they're going to be required to look country by country by country to ensure that they're paying at least 15%. The issue with it, if they're not paying 15%, so let's say that their corporate rate, let's say we dropped the dividend tax to 10, and that was the only tax they paid. It's not that Jamaica gets that additional 5. It's the country that they're resident in that gets the extra money. So we really need to watch this global minimum tax carefully, because it may not mean that Jamaica gets more, but we want to watch that space. What it means for us is we need to watch our corporate incentives and watch whatever we do when we talk about domestic changes to taxation. Because even though we're local investors and we're talking about equity, we're in a global environment, and you may find that what we do here impacts the way we are treated globally and how investors come into our market, or how we are able to invest in other countries. So countries with no income tax or income tax rates below 15%, they're really going to have to watch the space, because there's a top-up tax that the multinational is going to have to pay in their home country, which means if just because you may have a corporate rate of 35 or 17.5 or whatever, if the company, when it computes its taxation for purposes of this base erosion profits shifting, we call it 2.0, and it's below the 15%, they're going to have to pay extra tax. We have to watch that. So while we're talking about incentives, bear in mind that globally, this 15% is watching us. Another thing to bear in mind, it's going to be based on accounting income. It's not going to be based on taxation. So it's going to be interesting to see, because there are major differences between accounting and taxation. In addition, how you determine what is an income tax is going to be interesting, because this is only relating to income taxes. And it's the income taxes you pay as a company. So it'd be your corporate income tax plus whatever withholding taxes are levied on the income that's paid. So to give you an example, if you were an entity that was on the junior exchange and you were paying dividends to a multilateral that was subject to the 15% minimum tax rate, you would be okay, because that 15% withholding tax would be would hit the threshold. If we dropped it to 0 and you pay nothing, they would likely have to, I say likely because we're waiting to see more details, that multilateral would have to pay their home country the difference between what they pay and 15%. So we have to be very careful with the tax policy to determine how do we differentiate between local investors and foreigners and watch the space of the global minimum tax. These are some of the things to consider. Is 15% appropriate, an appropriate income tax rate on dividends? Because remember, it's an income tax rate. For Jamaican residents, should we as Jamaicans be paying the same rate as everybody else? The 0% with CARICOM, is that really something we should look at, or should we use that to say we should be investing in CARICOM? Because is it really a 0% withholding when those companies are paying taxes or are paying costs to establish those companies and do other things? From a perspective of taxation, should the individual tax rate for dividends be different than the corporate rate? Should pensioners have a different rate? It gets more complex, because we want a simple system where everybody just pays one. But is it time for us to look, knowing that the corporates globally are going to have this minimum tax? Should we as local investors have a difference? And will it work in the scheme of the global taxation minimum tax? Should there be a 25% withholding on gains earned in collective investment schemes? What are these collective investment schemes? Are they things that these are unit trusts that should we be investing in? Should we be paying 25%? 25% is not a final tax. When you receive it, and if your tax rate is 30%, you're paying 30%. So how will the global minimum tax impact the tax incentives offered by the JSC? Will it impact us Will it matter? We need to think on these things, as I like to paraphrase others when they talk about what we do with taxation. Something that's very dynamic, it's very interesting. We need to think about them and determine from a tax perspective, how are we treating our local investors fairly? How do we attract foreign investors and make sure they're not getting better than us? And how do we ensure that as investors who want to see Jamaica thrive, how do we progress? Another thing to note, the 15% withholding tax on dividends is in addition to the corporate income tax. So everybody knows that's double taxation. I'll point out, it's not uncommon. In the US, in Canada, and some of our Caribbean territories, they do this. Why? Some countries use this as tax policy to encourage, or I could say force, it depends on who you view it, companies to reinvest the income. Because if you have retained earnings and you have to take a 15% and pay it out to the tax authorities, you then may want to keep the money in your business and increase the investment to have more accretion later. So you may find that you defer it. Another thing I want to point out, to be careful of that 0%, bear in mind that if you claimed an employment tax credit and you dropped your corporate rate from 25% down to the 17 or any of those in between that, and you do have shareholders that have a 0% rate, there's a clawback. So under the employment tax credit, if you took advantage of it and you are paying dividends to any country and the withholding tax is less than 10%, please go back and refile because you have some additional taxes to pay. So I just wanted to make it clear some of the anti-avoidance provisions that are there that we should watch when we're talking about this. That's it for me. Back to you, Venetia. I will stop sharing. Thank you.
Thank you so very much, Allison, for unpacking all of that. That was some new information for me. I didn't know. And I see a lot more inequity that I didn't know existed, and also room for improvement. And again, this is one of the exciting areas that I'm sure we're all looking forward to discussing in a few moments. Our final speaker this evening, to put the cherry on top of the cake, is Mr. St. Elmo White, W. St. Elmo White. Mr. St. Elmo White read for the Bachelor of Science Honors degree in Mathematics at the University of the West Indies, and thereafter spent over 23 years in the life insurance industry, rising to the position of Vice President in one of the then largest such companies in the Caribbean. Mr. White has served the Department of Mathematics at UWI for over 17 years as Deputy Head and Senior Lecturer, and as Adjunct Lecturer for the year 2020-2021. He was instrumental in introducing the MSc program in Enterprise Risk Management at UWI, which has proven extremely popular with the business sector. He is a Fellow of the Institute and Faculty of Actuaries UK, and has worked in many areas, among which are actuarial technical, finance, investment, marketing, pensions, health, and life insurance. He has founded and serves as director of several companies, among which are Firm Insurance Brokers Limited, Actman International Limited, Mona Technical Solutions Limited, Feeds International Limited. Mr. White conceptualized, designed, and led the implementation of MAJIF Trust and serves as its consulting actuary. This entity offers professional indemnity and many other benefits to the doctors and all professions related to medicine. Mr. White has also served as trustee to several pension plans and is consulting actuaries advisor to the board of trustees of several such plans. He's passionate about the pension sector, believes that every worker or employee should have a pension at retirement, and strongly believes that with some changes in legislation, the pension sector could help to significantly transform the Jamaican economy. He's also the co-author of the highly successful book entitled Handbook on Personal Financial Planning, and has written numerous short papers on pensions and the importance thereof. He's currently writing 4 books to be entitled A Handbook on Pension Planning, Questions and Answers on Pensions, Sayings of St. Elmo, plus Cape Level Mathematics, respectively. Ladies and gentlemen, please help me to warmly welcome Mr. W. St. Elmo White. Mr. White, you're muted.
Okay, Madam Moderator, Mr. Jimmy Sullivan, Dr. Msbn, fellow presenters, audience, good afternoon. It is my pleasure to be asked to participate in such an august panel, although I must admit that I always agree with ladies first. But how does a mere man speak after two goddesses? Indeed, two goddesses steeped with knowledge, eloquence, and articulateness. But then a man can never give up. He must try. So I would like for you to help me with my slides. Slide 1. My friend, thank you very much. Now, there are many approaches to the subject, and my previous moderators have done the subject justice. I am taking the view that I support zero taxes, zero penalties, and as much incentive as is possible. Now, I know that governments like tax, but I suggest that the way I see it, they would get even more tax if upfront they charged no tax. I believe that this approach would lead to a more rapid expansion of the capital markets. I believe this would lead to an improvement in entrepreneurialism, more companies. I believe it would help to create more wealth in the society, more long-term investable funds. I believe it would help to bring the small man more into the picture of creating wealth rather than saving at very low interest rates eaten out by inflation in certain entities. I believe this would be good for all of us, our children, and our families. I believe it would create much more employment and would make the country a much better country to live in. And ultimately, the government would collect more tax. Now, I also have set out the structure of my presentation, and I'm not going to read everything, but I will try my best not to repeat everything that was said before. But I believe that's a thread that I would expect you to pick up during my presentation. So we're going to talk a little bit about the Jamaica Stock Exchange, stakeholders, withholding tax, local investors, and all of that. But I will skip the files that we have gone through before. So I will move to slide 2. Okay, and this is just really saying some of the things that we have seen about the Jamaica Stock Exchange. Bloomberg's best performing exchange in the world for 2018. Best returns to investors of over 500% for the period 2014 to 2018. Now, I don't want to read everything. All I'm saying, the Jamaica Stock Exchange, although little Jamaica, does have some international reputation and appeal. Question, are we really capitalizing on it for everybody? And I'll move on to the other fact, to the other slide. Okay, well, this is the same thing. There is something here that is blocking me though. May I come here? Sorry. Why do we have this? Sorry, the screen is a bit blurred here. Let me try to. Okay. All right. This is just information that we have looked at on the stock exchange. Clearly, no actuary will ever give a presentation without putting down some figures. We are not saying they're totally 100% accurate, but they help us to bring out the points we want to make. But I won't go through them, so we can just move on to the next slide. They are there. We look at the stakeholders, investment brokers, fund managers, banks, insurance companies, other institutions, financial and non-financial, government agencies, like NIF, very important, companies, local and global, and we can move on to the other because those can be read. These are some estimates, but we think very good estimates. The stakeholders, local institutions, about 80%, foreign, about 10%, local individuals, about 5%, foreign individuals, about 5%. And we have given the figures that go along with the and the withholding tax, of course, everybody know, is about 15%. But those are figures you can read. I don't have to go through them in any detail. So we want to move on. Okay, again, we would go on from here. It's just talking again about the same thing. Local investors. Well, what we want is let's aim to build wealth for small to medium investors. It's very important to bring the small to medium investors into the capital markets and to get them to build wealth for themselves. We don't want to penalize anybody for saving and investing. We want to provide incentives for saving and investing. We want saving and investing. We believe that saving and investing is key for economic growth. And what we did here was to look at just a small example. That if you had 100,000 small investors saving 100,000 per annum, it will be $10 billion saved annually. And this money will be available for business to raise capital and to promote growth. And the thing is, as a mathematician and actuary, one of the things that always is in my mind, that as large as any one thing may be, it is merely the sum of many small things. People miss this point all the while. It's the whole concept of insurance, the pooling of small monies. And it's the same thing with investment. If you can get the small man, all of them or most of them to be involved, you will be surprised how much capital formation comes from that area. And this is what I'm talking about when we say we don't want no tax and no penalties. Let these people believe that they have something to gain. And you might be surprised what could happen in the marketplace. We'll go to the next slide. Okay, collective investment vehicles. Now, I am very passionate about these, I'm telling you the truth, because all of these were created to enable the small man to enter the capital market. Clearly, they can't do it directly. They don't have the money, they don't have the expertise, they don't have the know-how. So it's very difficult for them to do it individually. I'll tell you a little story very quickly. I was in an investment house one day. I went to do some training and I was sitting by the receptionist waiting. And a gentleman came in and he said to the receptionist, I am here to find out how much money I can get. She said, from what? She said, well, the issue the other day, the share issue, I bought a few shares about 2 weeks ago. So I want to see how much I can get off my account. And the poor lady was flabbergasted. She didn't know what to say to him, right? Because he doesn't really understand equity investment. He just bought a few shares. And I believe this is where these collective schemes are so good. As a matter of fact, that's why they were created, right? To inform and educate and attract the small man so that they can use their expertise to create wealth for the small people. And this idea that you withhold this 25 or 15%, I think it's 25, Allison said, by the collective schemes. I don't know how the government could do that. Because in my view, they are fighting against their own objective. Why did I sat on the Jamaica Unit Trust Services Board for nearly as long as I have lived, right? And believe you me, that is somewhere where the small people could come with their little money and access the whole capital market and the real estate market, right? So I am very passionate about this, and I believe that all of these taxes should be removed, and I think it would make a very, very great difference into capital formation, investments, employment, and growth in the economy, and make a better country. Maybe let's move on to the next one. Okay, justification for no tax, no penalties, and provision of incentives. Well, you'll be encouraging individuals to save and invest. They have already paid tax if they're above the tax threshold. They are paying tax and dividends if they're below the tax threshold. Build their wealth faster. More capital available in the economy. Let me just move on a little bit. More jobs in the economy, and this is very important. I mean, a country wants people to be employed. You cannot be employed unless you have some economic activity. And I believe you're not going to have economic activity without capital. So it's very important. Reduction of the population below the poverty line, very, very important. And enhancement of the GDP growth rates. The small investors and participates in economic growth. A booming economy allows government to lower tax rates while increasing tax intake. So you can give it up front, but in the back, you could get much more than you would have given up. Maybe go on to the next one there. Okay, this you can read and see what we're saying. I'm not going to really, but the main point here is that removal of the withholding tax levels the playing field, which is one of the things about the topic, about equity. And I know my friend, Ms. Peart, has given a serious dissertation on how these tax things work, and I learned a lot from that. But I stand by this for the time being, notwithstanding, and I understand what she's saying, that we probably don't understand it as deep as we should. Okay, we will go on a little bit further there. Fairer to local investors, which is what we're really trying to say, since all investors can return the withholding tax, provide some form of incentive to encourage all Jamaicans to invest, make it part and parcel of our culture. That's another thing. We are not people that save and invest. We believe in a lot of short-term things. We need a lot of incentives to make that long-term pitch. Very hard. I've been in this business for a long time, and people find it very hard to commit to the long term. So they need as much incentive as we can give them. Could we just move on a little bit there? Our population is about 3 million. Approximately 40% are employed, about 1.2 million. Look at this, less than 20% of that 1.2 million are in pension plans. Now, if you look at it, the government gives very healthy tax relief to pension plans. However, what has been happening in the pension sector? A lot of companies have been coming out of pensions since the Pensions Act came into being. A lot of companies. So you find the number of people covered in pension plans, and pension plans do get quite a bit of tax relief, has been falling. Now, people might be more comfortable, although we have to work on that, and I am one of them working on it. As a matter of fact, I think pension plans should be compulsory. Let me tell you the truth, right? I think it should be compulsory. But until then, people might be more comfortable doing their own thing through vehicles that give them those incentives. So if you can give it to pension plans, why can't you give it to the collective investment schemes, right? Because most of those schemes were made for small people. And I'm more concerned with the small people. I want everybody to get it, but I'm more concerned with the small people. I tell you that 100%, because we need them to be uplifted in the society, financially and socially, right? So what we're really saying is this: we look at NIS, the compliance rate, which is supposed to cover the whole working population, is no more than 45%, and it's a compulsory scheme. People find we are not going in there, right? So you have a lot of people who should be benefiting from that, they are not in there, right? So again, we have to look at the alternatives, like the collective schemes, to give those same people an avenue where they can participate. Could we just move on a little bit there? Again, we're saying here, expertise in investments in like the capital markets is not readily available to each individual. The collective schemes, they have the expertise. And this is where the people who do not have it can get that expertise. And again, we want to say the government should do something, even if they can't do it for everybody. I believe institutions like that should be totally free of those taxes to encourage the smaller people to go there and put their money in. Maybe let's go on a little bit more there. Okay, how to create wealth. Embrace and understand the concept of compound interest. Budget monthly so that one can save on a monthly basis. Use bank, credit unions, insurance companies, and other financial institutions. And again, we give a little example there, but I'm not going to go through it because you can read it. So let's go on a little bit there. The government, more taxes to be collected at low rates in a booming economy, very important. We believe the level of financial education in the economy is totally below par, totally below par. And that is one of the problems we face too. So we are talking about educating and encouraging individuals to save and invest. But this is not just a government activity, because at Actman, we do a lot of that. And more companies need to be doing it. Provide and strengthen the legal and financial framework for investments. Regulate the market to ensure compliance, efficiency, and security. Create and build trust with stakeholders. Develop the culture of saving and investing. The wealth of a country is always in its people. Let's start this journey now. And I think that may be the end of the presentation. Thank you very much.
Thank you so much, Mr. White, for that final topping to the presentations this evening. Quite informative as well in terms of just giving us the perspective from the unit trust, the smaller persons who are also who you're an advocate for in terms of benefiting in the market. We're going to open our Q&A session now so that everybody can have an opportunity to raise any questions that they may have and ask our panelists. I'm going to take the opportunity to remind you, if you are not speaking, to mute your mic, keep it muted. And you can also place your questions in the chat, or you may use the raise hand feature and I will acknowledge and we'll take from there. We have our first question from Mr. Wayne Grant. And Mr. Grant, you may go ahead.
Hello, good afternoon. I was listening to Allison's Peart's presentation, and I was of the view prior, especially when I look at when I see ads in the papers that the unit trust that invests in equities were tax-free. So I was very surprised that they withhold tax. I was always of the view that those particular funds are tax-free, and they are actually marketed as tax-free in the paper. I had to go back and look today. I've seen most of them seem to that invest that are stock-based. So I only thought it was the dividends that are paid by the companies into the trust upon which taxes would be based. So I don't know if you could address that.
Yes, I can clarify that. So back in 2013, there were amendments to the Income Tax Act, whereby they were brought under the collective investment scheme. Prior to that, there was an understanding. It was a verbal agreement. I wouldn't say verbal. It was, prior to the tax reform in 2014, there were certain understandings that would occur that weren't codified, which was one of the issues that the IMF did raise. Now, what used to happen was there was a 51% or more investment in equity or real estate threshold that was understood that once you met that, the redemption gains would not be taxable. However, when the collective investment schemes were enshrined in law, that was not put in. The issue now is the tax authorities have always allowed it. I'm thinking it may have been an error where, when it was put into the legislation, it wasn't put there. I'm aware that it has been raised. I have raised it as well. And I'm told it is being looked at to see how it can be addressed. So what you may find is persons may not know, or persons that do know are in dialogue with the ministry to see how they can fix it, because it's an inequity that I don't think, and again, I can't go in the mind of the government when the collective investment scheme was put in. I don't believe that they would have wanted to do this deliberately. So it's my view that it's something that needs to be corrected and is about to be corrected. So what you may be seeing advertised is based on that understanding, because a lot of people, by the way, don't know that the law has changed. So in 2013, when it came in, if you're operating your business a certain way, you may not have looked to say, but hold on, this detail doesn't give a carve out for the 51% holdings that we are used to. So I'm just raising that in the law, there is none, but there is dialogue between the various entities and the government to see how to fix it. Bear in mind also that, there were certain carve-outs for unit trusts that were held by individuals for no less than 5 years. They weren't transferable. 75% wasn't paid out, and the investment of any year didn't exceed $1 million. So that continues. I'm talking about the stocks and, the equity unit trusts, which we all assumed would not be subject to this. So I'm just telling you that the devil is in the detail. And it's a caution story that when we make changes, that we codify things that have been understood, we have to read them and read them carefully, and don't assume that what you are doing carried over, because if it is not in the law, it doesn't exist.
So just one follow-up now. I'm just wondering now is if in practice, do you know if these funds do withhold the tax?
I don't know. I must admit, I don't know. No, if they don't withhold, have a discussion with them, because they may be, like I said, there is dialogue going on. So they may be able to tell you that, look, we didn't withhold because we're having this discussion and it's going to change. I'm just telling you what the law is, because I can only, people can promise things and it don't happen. Right now, the law says they're supposed to withhold. If they're not, they may have good reason or they may not realize. So have dialogue, because they may be in dialogue with the tax authorities, but I'm just going with what we see in law.
Okay, no.
Because until there's a change or any correction, the withholding stands.
Noted.
Thank you so much.
So I just I had to raise my hand. I tend to read too much. That's why I have 4 eyes.
Thank you so much, Allison. While we wait for another question, I'd just like to ask, do you think there's any merit to possibly the government looking at separating the tax policy for companies, local companies, or companies receiving dividends versus individuals receiving dividends? I'd like to hear what all our takes on the presenters' takes on that is.
Marlene, you want to go, or you want me to answer first? Because I think she wants all of us, right? Mr. White?
Yes.
Okay.
No, man, you go ahead, man. You're the tax expert. I say something, but go ahead.
We're all tax experts, because once you pay tax, we're tax experts, right? So one of the things that we have to bear in mind is this big word called arbitrage. They love to throw this arbitrage around. Arbitrage is when you take advantage of differences. And if we're not careful, if we have a difference, because back, Marlene gave a great history. If you note, there used to be a 33 1/3 on dividends, and individuals had a different tax rate from companies. When you have differences, they can be exploited. People like me, I will admit, will exploit them. If the law has an arbitrage, I'm here to tell you, I will legally take advantage of it. So I'm giving you that long answer to say, I do believe in certain instances we should have a difference because people are in different situations. And particularly with COVID, I believe, it's not just giving cash back to people, but we need to do certain incentivizing. However, we have to be careful how we do it because sometimes we've been incentivizing and the money goes overseas. We need to tie our incentives to building Jamaica. I sound like a nationalist, but I was born here.
Yeah.
So I tend to want to ensure that we do things to develop Jamaica. So knowing there's an arbitrage, I think that there should be a difference. I also think that there should be a difference between how we treat small businesses so that they can develop and be listed versus big companies. But we have to be careful because sometimes the small companies, they list to take the money and we don't know if it's reinvested in Jamaica. It means, though, I will caution complexity. There's an issue whereby we always want simplicity in taxation. When you have a simple tax system, we don't always have a fair tax system. So you also hear people talk about you should be paying the tax that you can afford. When you do that, it's not fair. So I'm giving you a very long-winded story to say, yes, I believe it. It would bring in very complex systems and we'd have to watch the arbitrage. But for me, I would love to see a differential. No, there was a tax credit given to small businesses. I do see that. But one of the things, and I like, people say, well, you compare us to these big countries. When I look at countries like Canada, they tax not just federally, meaning at the Canadian top level, but they tax by province. Can you imagine if every parish came with an additional tax on us? So Ontario does give certain tax credits to small businesses to encourage them to do certain things, but they don't give you a tax reduction. It's a credit, meaning you spend the money and you get it back. Right. So the employment tax credit is a great example of a tax credit. So I'm just putting out there in terms of differentiation. No, individuals. Should I be paying the same if I'm a pensioner or an individual who is, trying to find my way as a big person who earns a lot of money? Now, Jamaica is a unique place. And I've been warned, don't think because you have these foreign things, what happened in foreign, stay in foreign. One of the things that the dearly departed Roy Collister cautioned me when I kept talking about, why are richer people not paying more? You also want to be sure that whatever tax system you put in, you get the taxes. When the government brought in a differential tax system, they actually collected less because the wealthier people have ways of tax planning that the poorer ones don't. So I'm giving you all of this to say we have to be very careful. So I would believe that the small business engine is where we need to focus because we also find getting access to capital. I'm not going to bash the banks, but rolling up in a bank as a small business person, you may not always get the money. And even though we have angel investors, sometimes the tax authorities with their tax system, whether it is credits for R&D, because I don't think we do enough research and development. People have made fun of me when I said if we developed our own vaccine here, we would be 100%. But I am going long because I would love us to see some differentiation and take the hits with the complexity of the taxation. So that's it for me. So a long answer, yes, be careful, but we can have simple and have things that work. Have to have some complexity.
There has to be differentiation in terms of the sort of taxes applied because it's different courses for horses and the different needs that must be satisfied. And if you note, Allison and others, that when we look at, I think the junior market is a good example of how things have been successful for small business that you pointed out. And you can see that even within the COVID period, so many of them, which if you look back, would not have been resilient had they not built up that competence because they have gotten that sort of taxation relief. So there is different courses and we have to know also what stage of the game we are compared to an America, compared to so you have to take that into consideration and not wholesale put the rates that they would have on us, though because we're in a global world, Alison, I take it that you have to look at, and there might be some treaties that you have to look at what you do. But at the end of the day, you're going to have to take a very good look at what are the things that must be done in terms of taxation to develop our own country. You know, it cannot be monkey see, monkey do. It has to be targeted in terms of what must happen for the benefit. So I was on to, and I was also agreeing with you with your discussion. But I think we have more small and medium-sized business and more people that are below the rich level. That you must think about that. Those are the people you have to target, and you have to target them with tax reform that is going to bring them up, and in so doing, help us to create wealth and get out of the situation we have.
Thanks. Mr. White, do you have any comments?
I think after those comments, I'll just say I support them, because that's my view anyway about getting the small investors involved, and you should really have a differential. So I won't go any further than that. I think that's been well answered.
Okay, there's a question in the chat. It says, it's from Shavane Clark. It says, it's to all the panelists. It says, what do you think on Janet Yellen's proposed tax on the unrealized gains of the wealthy? Do you think it's practical?
I would answer that I would not want us to go there at all to actually do capital gains. I don't think as a poor country, we should be thinking about going there at all. So that is where I would put it. Sorry to interject on the panelists though.
No, man, that's fine. I will comment that, bear in mind that Yellen is not our Minister of Finance. So when she speaks, she's really talking about the US and how they're going to look to balance their budget. We did have discussions in Jamaica when we were doing some tax reform, because we've done a lot of tax reform. Sometimes we piecemeal it, but remember, it's not something you do one time and move. Things change, you know, the economy. I mean, my son hates when I say that the internet wasn't around when I was his age. You know, some of the things when I'm seeing blockchain and all of this, I pretend to be young and I pluck my gray hair. But if we don't know how to tax these things, we're going to find that we're not getting the revenue that we normally have. So bear one thing in mind. When you hear from Yellen, which you hear her speaking about how to balance the budget, put their views in ours, whereby I do know the IMF at one point did suggest that we tax capital gains. The government never did it. I want to point something out to you. I talk about complexity. When I practiced in jurisdictions like Canada that had capital gains tax, when I practiced, they used to tax 50% of your capital gain. You had to track it. Now, can you imagine if you have a piece of property? We have so much dead left in this country that we can't track to begin with. Can you imagine finding out what your grandmother paid for the piece of land? So when you have a capital gains tax, bear something in mind. The record keeping becomes very important. Two, we migrate. How many of us go foreign and come back, and go back to foreign and come back? You're going to have to track every one of those assets and deem to dispose of them each time. We don't file income tax returns because it's simple. If we're going to tax capital gains, you best believe every one of us is going to have to find maybe an accountant to determine how to track these things. So I am here to tell you, it is not as simple as saying I'm going to tax the rich and tax the capital gain. A lot of us have unrealized capital gain in the dead left that Granny have, that we have a toehold on, that if we try to go to the bush to claim it, we may have to pay tax on it. So that is to say, when Yellen speaks about her unrealized taxes, they tax capital gains. So when you have realized capital gains, meaning you've sold it and you have the cash, there's a tax policy issue about if you don't have the cash, should you be taxed? So if you're going to tax unrealized capital gains, if you don't have an exemption, for example, for your home, if your home appreciates, we're going to find the money to pay the tax. So I'm just giving you their issue. Thankfully, we don't have that. But I'm giving you all the reasons in case somebody is listening and say, but hold on, Yellen has a great idea. If we do it, in terms of complexity, if you think finding an accountant now is a problem, you're going to see the problems, because tracking our dead left, we can't find the land.
Yeah.
So I just had to put that in perspective. I'm from the country. Mr. White knows I'm very much from.
Indeed.
I'm just putting that there in terms of reality, where the capital gains on the lands, all of that stuff that we may not have realized, or, you know, you could be paying tax on it. So I think we should stay away from it, because we want something that's a lot simpler. And wealth, if we're going to have wealth creation, whatever granny left us with the piece of land can take us out of poverty. I keep threatening to go back to Lucy and retrieve district and grow Lucy yam. Why? Because I have relatives that would have had land that I could go and do that. If you're unfortunate and you don't have access to that, there is a difference between somebody that has land or a piece of land versus somebody that doesn't. So if we tax that, and worse, if you tax the unrealized portion of that, we'll just kill anything with small business. All the farmers would run away. So that's my long speech for coming from the farm.
Indeed.
Dr. Marlene Street Forest, do you think that the government's agreement with CARICOM that enables dividends to be 0% taxed if we local investors invest in other CARICOM regions, presents an unfair advantage or an incentive then to have capital shift from the JSE and to those other local markets? And do you think it should?
No, I don't think it's an unfair advantage. I think it depends on what the perspective that you're looking on and whether you are trying to overall develop a regional capital market.
Right.
The activities will flow where the innovations are. So the flow, I don't see flows really, and I'm biased and probably based on what I see in terms of the other islands, I don't see flow going there. I see them more coming here. So, but in any event, I think that the initiative is good because when you go, I go on many travels, and many of the times the fund managers overseas will say, but you do not have enough depth. And so if this action will redound to developing a regional market, it is something, it's something that we should embrace.
Yeah, regional, agree.
I think we don't invest enough in the other CARICOM territories because
is we investing over there? They don't come over here.
No, I'm not talking the big companies, I'm talking us, the small business. I'm not talking the big men.
Okay.
I am talking access to, for example, mutual funds, access to that. So yes, we as Jamaicans, I'm glad to see it, because we may say we want to invest here, but if we diversify across the region, it's good.
Yes. Which is
but I'm just saying us as small individuals.
Yes.
When you look at the Barbados mutual funds, when you look at what's happening in Guyana, so I'm saying us as individuals perhaps may want to look to see how because we get it tax-free.
But it's the vehicle, Allison. And the vehicle. And this is why we have encouraged the Caribbean Exchange Network, which was really connecting all exchanges.
Yeah.
But what we have found is a cultural problem where the others were not interested in the network. So, that is a problem. So it's the vehicle. And if we have the collective will to get that vehicle moving, I think you'll see more Jamaicans investing in those islands.
Yes. So I just wanted to make the point that the zero goes both ways.
Okay.
When we talk about, is it fair? I also reiterate, don't assume the St. Lucia and the Barbados are zero. A lot of people say, oh, I just need to set up in St. Lucia and Barbados. If you're in Jamaica, you've never visited St. Lucia or Barbados and you set up these companies, you don't have a St. Lucia or Barbados company, you have a Jamaican company. So there are costs outside that people just hear it and don't understand there's more to it.
Okay, St. Elmo, Mr. White, could you expound probably on your feelings about the pension, the taxation on dividends of pensioners, this whole evolution from where it was, it went down to zero, it went back. Could you tell us a little bit more about in terms of, just how you see the government being able to have some form of policy and the benefit that they may derive from possibly changing the way they treat pensioners?
Well, to be frank with you, the way pensioners are treated it's hardly any different from how the active worker is treated. In other words, there's a threshold. The threshold is a little bit higher than for an active worker. I think for the active worker, 1.5 million. For the pensioner, I think it's 1.6 something million. But apart from that, it's the same thing. When it comes to the pension income, that's how it is taxed. So if you get more than 1.6 billion, it is taxed just like how anybody else is taxed. And I don't see anything wrong with that because it is. And I think this comes into one of the things that Allison was saying, because if I am getting 1.2 million, and you're going to tax me and my 400,000, suppose you make it tax-free. So the rich man who is getting 50 million, he wouldn't pay no tax either. So some people like to say that pensioners shouldn't pay no tax. I don't agree with that. What I would say, you could raise the threshold to like 3 million. Yeah. And you say, well, those won't pay any tax, but over that, you pay so much tax. I would go along with that. But not to say you shouldn't pay any tax. Come right back to what you're saying. It is, if it is simple, it is not going to be equitable. It has to be a little bit more complex. So that is what I would say about that point there.
Okay.
What I could say something else though.
Go ahead.
I could say that right now, the government allows the individual up to 20% of the salary tax-free to put into a pension plan. I would want to say, I don't think it would hurt the government to allow up to 25 because government would come off much better if when people retire, they had a sensible pension, right? And the whole country would be better off. You're talking about long-term investable funds. So that is an area I think they could really look at too.
Okay.
But over the 20, though, St. Elmo, many persons are not taking advantage of that. So it comes back also to the mass education that you spoke about.
Indeed. And that's why I look at the whole system.
Yes, because when you're in the US, you hear, we have we hear 401k, we tend to watch what foreigners do. We have our own 401k here, but
indeed,
we don't take, and I mean, you hear as well, sometimes it's like taxation. People say, why should I pay tax? I don't like how they use it. I also hear the chatter that we don't have pension portability, but hey, it's better to have some pension because one, you don't know if you're going to get sick and your retirement is earlier than you think. The pandemic is showing us that it's better to have money aside, even though the stocks may have gone back, they're coming right back up. And I think more people need to plan for the future. When it comes to financial literacy, I think we need to get into our schools.
Exactly.
We need to
That's
get to
exactly the point I make it. It's one of the most needed areas in this economy. Financial literacy.
And delayed gratification. We want, I'm not saying I like my jewelry, I like whatever, but we need to wait a little to see what it is that we're going to get. So, I mean, I am of the view, and I agree that we should increase it. But I also believe that we as parents as well need to also take the responsibility to teach our children more, because every day one of them gets a little older and decides they want to buy a car, they want to buy this, instead of putting aside some of that money. I'm not saying buying a car is bad, but if I were to choose between buying a car and putting away for my pension, I am putting away for my pension.
I agree with you 100%.
One other thing I should point out, and again, I agree with Marlene, when we look at these big countries, we have to watch their size and scale. But another thing that I noticed Canada did, they allowed persons in their private, to top up their pension, which we do, but they allowed you access to it to buy homes. So they also give you some incentive because they understand that owning a home is value creation. So one of the things we could look at, and again, I'm telling you, Canada does it. I'm not saying it's going to work exactly, but I'm just giving an example where it was a great help to a lot of people to be able to access their pension. It may get people to invest because a great incentive to say, put money in your pension plan and you can get 5 million or 10 million, whatever the amount is that you can access. It's not just the NHT, but you can access your pension plan and you have to pay it back over time at, zero interest rate because you're borrowing from yourself. So those kinds of things we should do, particularly since owning a home is your sure way. For me, I think a piece of land even if it's just a whole spot that I own in my name, is something that I think will do amazing things for us. And if we can use our pension to do it, even better. Right, St. Elmo and Marlene?
I go along with you on that. And I think, to be frank with you, they are looking at a few of those things right now. They're working in the Jamaican scenario. They're looking at a few of them, how you can access the pension through some of those things. A limited number, the house is one, being very sick is one, especially if you're going to lose your house.
Yes.
They will allow you to save your house. But they're looking at about 5 or 6 areas. And I don't have a problem with that either.
But you see, if you don't have the pension, you can't do it. And I don't think we're doing enough to show people, to incentivize them to do the pension.
Well, and this is kind of what I was saying, that the government could do a little bit more there. But and as a matter of fact, my view on pensions is very simple. It should be compulsory.
Yes.
It should say everybody who worked should contribute to a pension plan, an individual. If you're not in a group, you must be an individual. You just set a minimum contribution, like 7.5% of your earnings, and everybody must do it. That is what transformed Chile. When they brought in the compulsory pension, Chile moved from a non-country to almost an economic miracle, right? And that is where I think legislation is not just there to protect who you legislate for. If you do it properly, it can do a lot for your country. Pensions is one of those areas. Long-term investable funds. And people retiring with money.
Okay, Mr. White, there's a question from Troy and Browning in the chat referring to government worker pension plan. It says, why is it that an individual can't have more than one pension? Yet our pension plans aren't taking full advantage of the maximum amount deducted tax-free.
Okay. I could say a few things about that. I have been active in that area. And there's a committee, not so active these days, but when I was president of the Caribbean Actuarial Association, I sat on that committee. It consists of government people, private sector, the actuarial accountants, the unions, all kind of people dealing with pension funds. And I made that presentation at that meeting, on one of those meetings, that this is foolishness. Why are you telling a man he cannot put some money? If you agree that 20% can be contributed on his behalf, what does it matter whether it's in scheme 1 and scheme 2 or in scheme 1? For example, I work at the University of the West Indies. I'm in a pension scheme there. The university don't even provide, well, let me not say it. I have my own consulting company. But because I'm in the pension, I used to be in the pension scheme there. I could not set up a pension scheme which would give me much more pension than what I could get up there. That doesn't make any sense, right? So they agreed to change it. And just to say, you can be in any amount you want to be in, so long as the total contributions does not exceed a limit. Now, that should have been in the law from a long time. I have been assured that it is coming up soon. So we'll see how soon is. I can tell you though, to date, soon has been very late.
You mean it's soon come? The Jamaican version is soon come.
Right. But they did agree, that is true, that, it really makes no sense.
The final question for the night from Mr. Wayne Grant, his hand is raised. You may go ahead, Mr. Grant.
Oh, thank you. I was going to raise that question that Miss Brown raised, but I have another interesting question. This is for us as, say, foreign investors in other countries. Observer article had I alluded to the fact that a lot of Jamaicans invest in the overseas market in foreign brokers. And I know that many of us are subject to tax on dividends overseas. Question is, what are the advantages and disadvantages? First of all, how do you go about accessing the tax treaty with the US? And what are the advantages and disadvantages of doing that? Does it mean if you were to try and access that lower rate on dividend? Because currently they are taxed at, I think, about 30% on dividends. from dividends received from foreign companies, particularly those on the public markets, are there any disadvantages, i.e. having to register with TAG if you try and access the treaty rate? And how do you go about doing that? Those are my 2 questions.
Right. So you see, one of the things people have to remind themselves of, once you cross over into the US, for example, the IRS watches with FATCA. So also, FATCA is a US thing, but Jamaica has a reciprocal. There's an intergovernmental agreement whereby the information that the government of Jamaica provides to the IRS, they also get information. And there's something coming called the Common Reporting Standard, where all of your bank accounts information for over 100 countries are going to be shared. So for anybody that has investments that you're not reporting to TAJ, I'm just telling you now what is coming. I call those sons of FATCA. So to come to your question, particularly for the US, when the US withholds, remember something carefully. The US treaty with Jamaica is a credit system, whereby if the US, if you are investing in the US, you are supposed to fill out a treaty return. So when you do the investment, there is a form that you need to fill out because FATCA requires it. And on there, it tells you if you're going to access a treaty and what is the rate. So once you give that to your broker, they ought to give you the relevant treaty withholding rate. Now, remember, unlike the 15%, which is a final tax, the US withholding is a withholding tax. So when the US pays you, they will withhold at the rate, depending on how much you own. When it comes to Jamaica, so let's say it's a 10% withholding that the US did. So you gave your broker the form, the relevant IRS form, they take off the 10%. So if it's $100 of dividends and you get 90, $10 has gone to the IRS. You have to report the $100 to TAJ, register and pay the 25% tax or the 30% tax that you are subject to. And you would then claim a credit for the 10% that the US has taken off. So if you don't do that, it would be double taxation. So to take you through it, so if it's $100, the US took off $10, you got 90 in cash, you would report the 100 to TAJ. And if you are at a 30% withholding, a 30% income tax rate, you would pay $30, but you would report $30 of tax, but you get a $10 credit, so you would only pay 20. So that would mean is $10 went to the IRS, $20 went to Jamaica. So it's not that you're going to pay $30 in Jamaica plus the $10 in the US. I just want to make that clear.
Indeed.
Now, you asked a question about what if it is higher? So let's say that you were, had a different rate where the US withheld a higher rate. You get into an issue of treaty-based filing with the US. So there's some US issues there. So you got to really watch carefully if they take off more. So if they took off 30, but it should have been 10, that's a US tax filing. Don't go to TAJ and ask from a refund. It's for you to go to the US to explain it. Now, if you are to file in Jamaica and you're supposed to pay 25% and they took off 30% in the US, you would have to get back the withholding from the US. You would then claim the 25 in Jamaica or the 30, depending on the differential. Bear something in mind. If you don't file the tax return, you are technically breaking the law. So with the common reporting standards out there, if you do have investments in the US and they took off 10%, or even if they took off 30%, look to start to file. Because don't assume TAJ does not know. They are going to know, and they're going to know soon. Under FATCA, there was a de minimis test of some thousands of dollars. It's a $600 threshold now. So I'm not here to frighten you, but I'm telling you to do what you should have been doing all along. But sometimes we just assume the withholding is it, and make sure that you look very carefully. So again, I'm going very carefully through the questions so you're aware what is coming, because some of our Jamaicans think, oh, TAJ don't know. With digital, TAJ knows. So we wouldn't want any of us to inadvertently find ourselves owing some levies, being called up in front of tax court, go and look and ensure, because the TAJ website has some really good information. They've really stepped up their game with it. It has information here. And I should give a plug. I know I'm not here on behalf of the ICAJ, but I should say for financial literacy. I am a big supporter in financial literacy. And one of the initiatives I've done as I'm a new president, as a CPA Canada member, I used to teach financial literacy in Canada, in Toronto. So I have partnered with CPA Canada, and they're giving us for free a 1-hour financial literacy course that is normally offered in Canada that I'm running with the ICAJ. So if you're interested, go on the ICAJ website. It's no cost to you. It's an hour. It just gives you, as a small business person, very simple understanding things. So I'm trying to bring to Jamaica some of the things that these foreign jurisdictions do to their small business people. And I was able to get it free. So it's a plug for financial literacy. Free to all of you. Very few things in life are free.
Yes, that's a very good program, because a lot of our small businesses don't have the proper records and they lack financial literacy. So yes, that's a good one. I'll follow.
No, bear in mind it's 1 hour. So we can't bring you into an expert in an hour. But what we're trying to do at the Institute of Chartered Accountants is to do something more, because I am guilty of it. As accountants, we come with a big word, the IFRS and the big, and we forget that each of us need to understand some things. So I'm trying to bring it so that it's words that wherever in the world you are, cash isn't profit, you should know, because if you don't have cash, you don't have tax. But we're trying to give some information that foreign companies get by being in foreign. So I have no shame to beg for Jamaica.
Okay. One final question before we wrap up for the evening. I think somebody had asked earlier, will JSE offer any type of blockchain assets for investors in the near future? Can you say what's the timeline? I think that one is for Dr. Arlene Street Forest.
We are working on that as we speak. And we have gone a far way. You know, we have looked at all the risk and how we mitigate it. So the ecosystem has to be tight. And we have gone a far way in terms of that. If we get our board's approval, we should be able to launch in January 2022.
Awesome.
So that's a few months from now.
Wonderful. Thank you so much, everyone. I think we're making good time this evening. I see lots of persons in the chat really commenting and saying that this has been super informative, very, very informative for them. And so our expert panelists did very, very well in terms of educating us this evening on the various aspects of the equities and the taxation and all of the issues. A lot of things that were not clear to us are now absolutely clear. And so we're very, 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 very grateful for that. One of the main takeaways from this evening is that certainly we have to look at ensuring that our population is financially literate, and certainly from a very early age. I would like to take the opportunity to thank our presenters, Dr. Marlene Street Forest, Ms. Allison Peart, and Mr. Winston St. Elmo White for their very, very, very informative and exciting and vibrant presentations about the various areas that have to do with equity and the dividend taxation policy. I would like to thank Mr. James Moss Solomon for identifying this very exciting and important and timely issue for discussion for our MSBM forum. I would like to also extend thanks to Dr. Msbn for supporting and for welcoming the attendees. He has always been very supportive of these fora. And I would also like to thank the Institute of Chartered Accountants of Jamaica for really being one of the main advertisers and promoters of this session this evening. Thank you very, very much. A big thank you to our MSBM marketing team, Janice Henlin, Justin Harrison, Dawn Morgan, Sigourney Jackson, and Tamara Thomas. Our technical support team, everyone, including Rashawn Titus, all the other technical team persons. I don't want to call names and miss anyone. Brian Hall, everyone that was there earlier. Thank you very, very much. All the persons and organizations that helped in the promotion, the Jamaica Stock Exchange, the Faculty of Social Sciences, the Jamaica Chamber of Commerce, the PSOJ, Power 106 FM, UWI's Marketing Department, and the UWI Mona at large. And a very, 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 very big thank you for all of you who attended this evening. Without you, it would not have been such a success. Thank you for attending and thank you for spreading the word. Remember again to visit the ICAJ site for the other session that Allison told you all about. And I invite you all to follow MSBM on social media, or Facebook page, or Instagram page, or LinkedIn, YouTube, and Twitter, so that you won't miss any more of these events that we have in the future. Thank you very much, all of you again. Have a very good evening. Remember to wear your masks, sanitize, wash your hands, stay safe, and blessings to all.
Very good.